Hi, good morning, everyone. So today we'll have HMI, UOB. UOB is the corporate day update. We have Penguin, Asian Pay TV, ComfortDelGro, SATS, ECO, CDL, Banyan Tree, FCT, Sembcorp, China Everbright, CNMC, Golden Energy Resources, and Netlink and Singtel. So there's a lot this week because of last week's holiday. And then we have our usual REITs monthly, and then US and China weekly. So for HMI, the results was released around 2 weeks ago. So the main positive for them is that their patient load is still growing, and this is mainly from the Malaysian hospitals Mahkota and Regency. So this time around, it was inpatient that drove the growth, so 2.6% year-on-year growth for inpatient, while outpatient grew 1.1% year-on-year. And the other positive is the increasing patient bill sizes. So the reason why their patient bill sizes are still increasing is because they are performing increasingly complex surgeries. So with higher complexity, they are able to charge higher bill sizes for the patients. Another portion is the Center of Excellences, also referred to as COE. So COE refers to things like oncology, specializing in cardiology, etc. And another area is the investment in medical technology and also recruitment of specialists and subspecialists. So with this niche area of medical treatments, they're able to attract greater referrals, as well as increasing marketing will also boost awareness of these services as well. And then the bed occupancy rose to 61% this quarter as compared to last year of 59%. So this is quite a good figure because their number of beds remain unchanged, but they're still able to achieve higher bed occupancy. And also things to take note is the Regency, they're going to have a new extension to add 380 beds by 2021. And this 380 beds has the potential to expand to 500 beds because they have extra space set aside for more expansion in the future. And the negative this time around is StarMed. Their gestation costs have already kicked in. So we expect it to weigh down PATMI for the next 2 to 3 years. So excluding StarMed's gestation costs, you can see over here the core PATMI this quarter, inclusive of StarMed, it decreased by 15.9. And if we were to exclude StarMed, it will actually increase by 10% year on year. So this also indicates a ringgit 4 million net loss from StarMed this quarter. And to compare to the previous quarter when it first started incurring gestation costs, previous quarter was 2.9 million. So this quarter's 4 million is a more indicative figure because it includes the depreciation costs as well as finance costs from StarMed. So because of this quarter's net loss, we are able to project and forecast our EBIT loss for StarMed better. So we raised our EBIT loss assumptions to ringgit 6 to 9 million for the first 3 years of operation. So this resulted in a lower EBITDA for FY19 and 20 by 3% and 6%. The outlook for HMI, despite the suppression of earnings in the near term, 2 to 3 years due to StarMed's gestation costs, we maintain our view that Malaysia will benefit from the public and private healthcare initiatives and also increasing domestic insurance take-up rate. And they also have a favorable demographics in Malaysia as well, such as the aging population. And Malaysia also, the healthcare scene has a cost competitive pricing as compared to their regional peers. So we maintain buy for HMI with a lower target price of 0.73. And this is mainly due to us incorporating higher gestation costs for StarMed's first 3 years of operation. So for more updates on the respective hospitals, Mahkota, Regency, and HMI, and StarMed, you can refer to my report. For UOB, this is actually an update report for their UOB corporate day last week. So for UOB, they shared about their future plans. So over here, you can see that the future customers, they're targeting ASEAN's rising young population. So around 60% of whole of ASEAN is under 35 years old. And it's also they also own, 52% of them owns a smartphone. And as you can see from the first chart here on the left, a majority of the clients that they have, they would rather have a physical interaction before purchasing higher value items. So you can see that SMEs only 25% prefers to transact online, mortgages only 20%, and wealth management is only 20%. And affluent customers is only like 30% that is willing to transact online. based on the evolving customer needs, UOB realized that they need to have both digital and physical branches. So they call this the omni-channel approach. And from the right hand side chart here, above 56% would only above 56% of UOB's customers prefer physical contact when they purchase high value products. For omni-channel, the percentage of UOB's customers using both traditional and digital increased the fastest, as you can see in the top chart. It grew by 37% as compared to 34% in FY17. And omni-channel customers also has the most significant contribution to their revenue as well. And in previous year, FY17, it was the traditional customers that contributed the most. But as you see in FY18, it was omni-channel customers that contributed the most to the revenue. And the interesting thing that they shared during the corporate day is the Tomorrow app launched in Thailand. And it's the ASEAN's first mobile-only digital bank. So what is special about this is there's no physical bank branches at all. And it's basically using the app itself to transact, and also with 500 kiosks located around Bangkok. So authentication of the customers can be completed within 10 seconds using a match of chip to the government data. So no physical branches, only kiosks. And UOB, they also shared their sentiments about the trade war. So with growing sentiments among, they observe growing sentiments among corporates, especially technology and electronics companies, to shift their supply chain out of China into ASEAN. So you can see from the chart here, the top chart here. So a shift in supply chain, they do not expect it to happen overnight. It will be over the few years. And a natural consideration by these companies would be countries such as Vietnam, Thailand, and Indonesia, where labor is cheap. And just nice, UOB is also very well positioned with a wide Southeast Asia footprint to serve both the suppliers and the distributors. And UOB's key market is Southeast Asia as well. So Indonesia, Thailand, and Malaysia are UOB's key markets. So as you can see from the chart at the bottom, their exposure to Greater China decreased over the past 4 years. And Southeast Asia is the majority, is the biggest part of their revenue generating unit right now at 73%, while Greater China is only 24%. So if you want to look in terms of trade war exposure, UOB is not as exposed as the other two banks. So next I'll pass on to Paul for Penguin.
Okay, thanks, Banyan. I'll move on to Penguin's first quarter results. Sorry, we still maintain a buy on Penguin. The first quarter results, we saw revenue actually dip 40%, but we'll show you later. But I mean, this is quite normal. As you recall, this is a shipping yard, so the earnings is very volatile and lumpy. It depends on the number of vessels sold and the amount of work recognized. Okay. In terms of the positives, the issue is that the company doesn't give order book. So as a result, we actually have to use the balance sheet to get some sense of what is the outlook. So as you can see from here, inventories was up almost threefold, and actually the assets for sale was about 6 million. So for inventories, there are two ways you can interpret this. Either they're stuck with a lot of vessels they cannot sell, or there's going to be a bumper recognition of revenue the next few quarters. We believe that there's going to be some the inventories are going to be. We expect some good revenues coming up from all these inventories that has been built up at least in the first quarter. The other positive has been the net cash continues to pile up. It's about 44 million. I think almost 40-50% of the market cap is net cash. The other part, another clue in terms of the outlook that one can use is through their other payables and accruals, because inside this category are also advance payments by customers. They do not separately disclose how much is advance payment, but we believe part of the rise is actually due to this advance payments. In terms of the negatives, again, the revenue, there's no separate line on charter income, but we think that because they move some of the assets that are used for charter income into this assets classified held for sale. Basically, what happens is that some of the crew boats, as you know, to recall, the crew boats, the revenues in charter income and sometimes when there's an opportunity, they actually convert these so-called crew boats into security vessels for the Nigerian market. Once they do that, they actually will take these assets out from their PP&E plant and equipment, and then they'll park it under assets held for sale. So as a result, you can expect some revenues to come from this, because once it is converted, there will be some sale from this. In terms of the next chart, anyway, just to give you a sense of the volatility, at least on a quarterly basis. So at least over the past 3 years, I think revenues have swung from 6 million to 41 million. Again, all this depends on, and I think profits are the swings are even wider. So what it basically means is that it all depends on the sale of vessels they have in inventory. Again, just to recap, they actually build to stock. So some of the vessels they build actually kept in inventory. These are security vessels and the crew boats, and also and for the last bullet point, there's no change in our positive outlook. As per our initiation report, some of the reasons why, apart from the valuations, of course, they are trading about 5 times PE. If you take out the cash, they're probably trading about 3 times PE. But anyway, some of the reasons why we like the 3 drivers to growth is, of course, there is some revival in the offshore oil and gas activities. For them, Malaysia is particularly important because a lot of the crew boats come from charter income comes from Malaysian waters. The other part is the increased market share. If you recall, some of the major competitors, like someone like Tri-Yachts, actually facing obviously under debt restructuring mode. So as a result, they actually managed to capture a lot of market share the last 2-3 years. And also the third point is that one of the reasons for the growth is that they successfully diversified over the last 2 years or 3 years outside their core crew boat and security vessels. So these are basically some of the 3 growth drivers for this particular company. Okay, thanks. I'll move on to the next one, which is Asian Pay TV results. We actually cut our recommendation to reduce. Firstly, just on the results, the positives was that their cable TV ARPU, which is the selling price, actually only contracted 1 NT dollar. If you over the last 3 years, the cable TV, which is the biggest revenue driver, as you can see, one of the things that has been dragging it down, apart from subscribers, has been ARPU, which is selling price. But after 3 years, this quarter we saw one of the smallest contraction quarter on quarter. So that's a healthy sign. The other 2 negatives is that the cable TV subscribers continue to shrink. I'll just swing you to the cable TV subscribers continue to shrink, so that remains a negative. And also, there's no sign of this abating. And also the capex is still elevated. And also the third thing was that broadband was supposed to be the growth engine, but it hasn't really moved. As you can see, it's still contracting. In terms of outlook, the operating metrics are still slipping. We actually cut our target price to 16 cents. Actually, we are benchmarking. There's supposed to be a slide here, but we're benchmarking it to their Taiwanese peers. If you look at the report, we actually put a comparison with some of the Taiwanese peers. So our 16 cents is just benchmarking it to the Taiwanese peers. As you recall, since they mentioned their strategic review, the share price has been up almost 40%. We think there's a bit too much premium being priced in for this particular stock, because they're actually now trading very, very close to some of their peers, and these are really huge, the Chunghwa Telecoms and so forth. These are really huge telco players. And just to recap, any acquisition, anybody who wants to take control of Asia Pay TV doesn't need to do a general offer. You can just take control of the trustee manager. You don't really need to buy the whole thing and take it private. And if you do take it private, there's always a lot of regulatory hurdles. For media assets in Taiwan is extremely politically sensitive. So it's not been not an easy route to go and take this Asian Pay TV private. Okay, thanks. Move on to Guangzhou on Sembcorp Industries.
Okay, thanks, Paul. Next is Sembcorp Industries first Q results update. So we maintain our buy call with a target price of $3.75, and the target price is an unchanged price. So the positives for the first quarter was that the SEIL Project 2 turned profitable amid a high plano factor. You can see the table here. And meanwhile, the UK PR also delivered $18 million profit from operations due to the recognition of the trial payment. Please bear in mind that for UK PR, usually the first Q and 4Q are the peak season, and the performance from UK PR is quite volatile. So we do not expect the second Q and third Q UK PR will constantly deliver such a high profit. And the negatives was that the SEIL Project 1 lost about $11 million. This was mainly due to the temporary shutdown of the Unit 1. So after mid-February, the Project 1's unit resumed work. So we expect that the rest of the 3 quarters, the Project 1 will deliver stable performance. So the outlook for Sembcorp Industries is that we expect the Project 2 will secure long-term PPA for another 500 megawatt in this year. And also, there were some uncertainties over the regulatory change of the UK power market because of Brexit. And the last thing is we do not expect a big turnaround from Sembcorp Marine in the near term. Next is China Everbright Water. We also maintain our buy call with a slightly higher target price of 50 cents. The positives for the first Q was that the company secured another 2 more projects, including the operation and management project and a sludge shipment project. And also 7 wastewater treatment projects had tariff hikes ranging from 21% to 56%. And the biggest event for the company was that in May it successfully listed on Hong Kong Stock Exchange. And as of 16 May, the closing price in Hong Kong and SGX has about 11% price difference. So the outlook for Everbright Water Group is that we'll explore the new business expansion in southern part of China, because right now it has a strong footprint in northern part of China, especially in Jiangsu and Shandong provinces. And also in the first quarter, the authority published the upgrade of urban wastewater treatment quality action plan 2019 to 2021. And this plan specifies areas demanding wastewater treatment, and also it will reinforce the fiscal and social financing support. So for those SOEs such as Everbright Water will be benefited from this policy. And the last thing is the lower VAT from 16% to 13% will also help the company to relieve the tax burden. So this amount is expected to be RMB 40 million this year. Next is CNMC Goldmine. We maintain our buy call with an unchanged target price of 31 cents. The positives was that the final production in first Q arrived at the 4th high in history with 78% year-on-year growth, and also the respective utilization rate of the 3 leaching plants like wet leach, heap leach, and carbon leach reach high percentage. So especially for carbon in leach, which is the plant that deliver the most production, already hit more than 100% utilization rate. And the negatives for CNMC is that the quarterly comparison of gold production underperformed. So you can see here the quarter-on-quarter gold production dropped by 21.3%. So this was mainly due to the short-term halt in production because of the replacement of the ore milling system and the holiday effects, and also the lower ore grade. So the outlook for CNMC is quite upbeat. You can see this is the expansion plan for the company. So all these plans is to ramp up the production as well as to reduce the operating costs. One thing we want to highlight is that this year they will establish the floating facility to monetize on other minerals such as silver, zinc, and lead. So we expect that this year the financials as well as the production will have a big turnaround. Next is Golden Energy and Resources. So we downgrade our call to accumulate with a lower target price of 24 cents. The positives for the group is that the quarterly production in first Q reached a historical high of 7.1 million tons. This accounts for 28% of the annual target for this year. And also the cash costs decreased by around 9% year-on-year and 22% quarter-on-quarter. So the ASP drop was mainly due to the fall in coal prices as well as the change in terms of the coal hauling services. So in the past, the coal hauling services were charged by hourly basis. Now it will be charged by a distance basis. And the negatives is that the overall coal prices dropped substantially. In first Q, you can see here the ICI average at around $38.6 per ton. So you can see the quarterly and year Q-on-Q and Y-on-Y comparison on this table. So the outlook for gear is that it will have the tailwinds that the production, the ramp of production is on track. So we expect that it can achieve the 25 million tons of output this year. And the price having is the primary concern, but we still hold our forecast of ASP at $40 per ton because right now the ICI 4 recover since March. So all in all, we think that the overall performance for this year is comparable to FY18 because the ramp up of production will offset the drop in coal prices. So also we need to highlight that the two investments over the past 2 years actually perform quite well. So the investment in Vesco was that the last trading price was around $1.60 Aussie dollars, about 20% drop. However, the recent acquisition of Sembcorp actually is making about 50% gain on paper. So overall, these two investments will help the balance sheet. So next, I'll pass on to Alvin.
Thanks, Gong Zi. So Netlink results came out 2 weeks ago. We maintained our accumulate call with a target price of 93 cents. Previous was 89 cents. So as you can see, revenue, all of the metrics have exceeded the management projection, and quarter-on-quarter, year-on-year, 4Q19 and 4Q18 have also increased substantially. So this is on the back of better than expected residential connections. Do note that resident connections contribute more than 50% of total revenue. So the residential connection grew to 1.33 million, surpassing IPO projection and our forecast by 3.9% and 2.1% respectively. So we have attributed this growth to the newer estates in Singapore, which is the Tengah and Punggol. So we have subscribed a 10% growth rate in the following year. We also expect potential for 5G, as IMDA has said that they prefer 5G to be a standalone network, which means the telcos will have to roll out the 5G network independently, so they will not be using a shared network. So that's the desire for IMDA. So this means that there will be more demand for Netlink's fiber infrastructure, as a standalone connection, standalone base station will need a lot more standalone 5G network will need a lot more base stations. So for the negatives, there's lower than expected non-resi and embed connections. The Smart Nation initiatives has taken a while to come back. So we believe that there will be stronger demand, as also management has guided in FY20. So we dialed back our growth expectation in non-resi. So in recent news, SP Telecom has said that they will build their own infrastructure, fiber infrastructure. We do not foresee a huge impact as the non-resi segment has already been very competitive. And also non-resi has only contribute 8% of the total revenue. So impact will be very minimal for Netlink. So outlook, we think that will be higher capex because of the progressive rollout of the new residential estate in Punggol and Tengah. The expansion includes the expansion of infrastructure and upgrades. They also guided higher residential and installation-related revenues. We think that embed will gain traction and non-residential will remain stable. So for Singtel, results were in line with our expectations. For revenue, increased 1.9% year-on-year. This is on the back of the ICT and digital services, which helped offset the legacy carriage services. EBITDA, however, did not do as well because of the margin compression of the enterprise business. So enterprise business had a higher mix of ICT contribution, and ICT contribution has a lower margin as compared to the core carriage business. So ICT normally contributes 10 to 15% margin, while core carriage, as communicated by the management, is about 20% margins. So the regional associates did not do as well as we expected. Airtel has widened its losses to 98 million. We believe competition will still remain strong and very intense, and we think it should stabilize going forward as the recent rights issue has given Airtel a substantial balance sheet to continue its fight with Reliance Jio. So Telkomsel improved 2% to 223 million, and Globe surged 38% year-on-year on the back of higher data revenue and increased demand for internet services. So Globe has a higher chance to monetize data as most of its customers are still using traditional voice services. So net profit was up 0.4%, was down 44% year-on-year for the full year because of the one-off divestment gain of Netlink. Stripping away those gains, full year would have been down 14%. So for dividend, management have decided to give 17.5% for next FY20. So positives is that the digital business is gaining traction. GDL revenue has spiked 33%, attributed to Amobi and its programmatic platform business. Management has guided a mid-single-digit increase in revenue and EBITDA to improve. This group Digital Life has EBITDA loss of 90 over million. The other positive is that Singtel is going digital to optimize costs further. An example is a GOMO, which is a pure digital product. It's a SIM-only plan. Everything is done online, targeting the digitally savvy. So cost savings has led up to 441 million. This is also because of the staff optimization costs and other cost savings from distributions. Management has also guided 420 million cost savings in FY20. So for outlook, we think that we still like Singtel because of its recovering associates and a stable dividend yield of 5.6%. We think that the enterprise business should improve because of increased ICT and Smart Nation contribution. So for 5G, management has shared that Optus has plans to deploy 1,200 base stations. The consumer use case in Australia is much stronger in Singapore than in Singapore because of the low broadband penetration. So we think that this Optus foray in 5G will help smoother rollout in Singapore. So with that, we have a accumulate core, maintain our accumulate core with a higher TP of 3.31. Next, we'll have Natalie.
Hi, so today I'll be talking about ComfortDelGro's first quarter 2019 results, which was released about 2 weeks ago. All in all, ComfortDelGro's revenue increased by 7.8%. This is mainly attributed, 80% of it is attributed to the new acquisitions in Australia, and 20% of it
was from the growth in the existing businesses. Mainly the one that drove the growth was the public transport services. So all in all, due to the bump in revenue, PATMI grew by 6.2%. So as mentioned, the positives are that the public transport services revenue, it grew by 12% and the corresponding EBIT grew by 30%. This is mainly due to the improvement in Singapore operations, which saw higher operated mileage from the bus services, as well as higher ridership from an average fare rate from rail services. CDG has also rolled out several initiatives to help retain drivers. They are the dynamic pricing and the profit sharing schemes, which will be further elaborated later on. This is to help increase the drivers' revenue and thereby retain their fleet of drivers. For the negatives, the first Q results fell, revenue fell by, the taxi revenue fell by 5% year on year. This is due to challenging circumstances faced in Singapore and China. On the Singapore side, the smaller fleet size weighed down revenues, and in China, what they're facing is previously a lot of drivers would take up 2 shifts, but currently the take-up rate for the double shifts has fallen from 70% to 50%. For the outlook, ComfortDelGro is growing their fleet size. So in 2018, the fleet size was actually at the low. They actually delayed replacing their taxis and increasing the fleet size until this year. What happened was now that they're increasing their fleet size, they're actually able to capitalize on the lower COEs. So they replaced the higher COE taxis with lower COE hybrid taxis. There's also more demand for hybrid taxis. So by switching from diesel to hybrid taxis, they are actually able to charge a higher rate for the hybrids. So they received 300 taxis in the first quarter, and they will be receiving another 300 taxis in the second quarter. So as previously mentioned, the schemes and initiatives to tackle various pain points faced by the industries are the voluntary profit sharing scheme. This is basically to offer a lower taxi rental. So previously, the going rate for full day taxi rental is about $105, and by offering a 20 to 35% discount on the fixed full day taxi rate, they will take a 15% share of the fare takings. So this actually makes it more economical for people who are looking to drive for shorter hours, meaning less than 8 hours. This will help them increase the fleet size, but also due to making it more economically profitable for drivers. Another initiative would be the dynamic pricing through ComfortRight. This is to address existing taxi drivers' concerns of missing out on higher fares during peak hours. So for Grab, they will usually have surge prices, and this is something that has been lamented upon by taxi drivers. And so one way of combating it is to introduce this dynamic pricing. So it helps to remove one possible incentive for switching. It helps to remove one possible incentive for taxi drivers for switching to Grab or Gojek, as they now can benefit both from street hail and enjoy dynamic pricing, more competitive pricing during peak hours. Another thing to take note of is that there's the public consultation regarding the proposal of 2 new license classes, which is the street hail and the ride hail services operator license. This is still under deliberation. So previously, the taxi driver operator license, which is held by the taxi companies like ComfortDelGro and SMRT, this allows them to take street hails. But if they were to introduce these 2 different operator licenses, ride-hailing services can also apply for the street hail license and therefore compete directly with taxi providers such as Comfort. So this is still under deliberation, but what happens is that if Grab decides to take up the street hail operator license, they will also have to maintain a fleet size, which we do not think that Grab will be interested in doing that, because it will mean additional capex. This is yet to be seen. All in all, we still maintain a positive outlook for ComfortDelGro. we reiterate our accumulate call, and with an unchanged target price of $2.72, this gives an implied full year 2019 estimate forward PE multiple of 16.8 times. This is a screenshot of the various segments and geographies that Comfort operates in. So we can see that Singapore actually accounts for most of the revenue, as followed by UK and Australia. Based on revenue segmentation, the public services accounts for the bulk of it, followed by the taxis at 51% and 26% respectively. So this year, as mentioned, the public transport segment revenue grew significantly. So to have a better look at this table, you can refer to our report. Moving on to SATS. So SATS reported their full year 2018-2019 results also 2 weeks ago. They have two main revenue segments, which is the food solutions and the gateway services. Both 4Q was a bumper quarter for them. The food solutions grew by 7.5% and gateway grew by 15.7%. The growth in food solutions was due to growth across all their catering subsidiaries, and the gateway services grew. Most of the growth was actually attributed to the consolidation of Ground Team Red. This was previously accounted for under their JVs, but now it's been consolidated as a subsidiary. This is not because of any change in equity or ownership per se, but more because it was consolidated on the grounds of SATS having management control or operational control of the entity. So for revenue for 4Q grew by 13.3%, and like mentioned, 44% of it was actually attributed to the consolidation, without which the revenue grew by 6.3%. One thing to note is that for this quarter, the associates and JVs was actually much lower. It was a negative 63%, but this is because of several one-off items, without which, excluding the one-off items, the revenue from associates and JVs would have been 11 million, which is higher than the 9 million. So for the quarter, the underlying PATMI, which is from the core operations, actually fell 5.4%. But on a full year basis, underlying revenue grew by 2.2%. So the growth in food solutions and gateway, they grew by 4.4% and about 8% year on year for the full year. And this is the growth showing from aviation up by 12% and non-aviation up by 9%. Another thing that was announced is that SATS is acquiring a 50% stake in Nanjing Weizhou Airline Food Corp. This is an entity in China. So the acquisition is actually a 45% acquisition, followed by a 5% subscription of shares. So that will bring their total stake to 50%. This will cost them about 31 million Singapore dollars. And so Nanjing Weizhou has a food network of 12 cold storage facilities and distribution channels, and they serve about 80 airports domestically. So based on our using our 2020 PE assumption of 24 times, the deal could add about 1.3 million to SATS bottom line. On the negative side, the food and cargo volumes at Brahim's and PT Cares remain flat. The cargo volumes are actually dampened by the ongoing trade tension. This was already present in the last quarter. So for our outlook, we still expect the passenger traffic to grow, and their SATS efforts to use the digitalization will provide efficiency and productivity gains to cope with the pricing pressure from airlines. So another thing that was announced recently was the renewal of the contract with SIA on a 5+5 year term. This will cover majority of the revenues from SIA, and it will provide more certainty of margins and pricing moving forward. So SATS has actually been quite actively acquiring JVs and in China, and one of the ways in which they attempt to strengthen or deepen their roots in China is investment in central kitchens. This is similar to their strategy in Singapore. So by having central kitchens, it will allow them to fulfill the demand from the fast casual restaurant chains in key cities in China, while supplementing the shortfalls in the flat kitchen. And this expectation of volume growth is driven by aviation demand, as well as demand for quality food. This is more for the China side. So we maintain our accumulate with an unchanged target price of $5.47. And this gives us an implied 2019 P multiple of 24 times. So moving on to EC World, this counter is actually covered under the stock facts program. So for EC World, their first quarter results, gross revenue fell by 0.3%. This is mainly due to exchange rate differences. In renminbi terms, the gross revenue actually grew by 3% year-on-year due to built-in rental escalations and contributions from the acquisition of Wuhan Meidorte. So all in all, their distributable income was up by 3.1% and DPU was up by 2.2%. For EC World, they actually hedged their distributed income, 75% of it, on a 6-month rolling hedge. So for the positives, the master lease that was proposed for 3 assets last quarter was actually approved, and this will extend the WALE. This will extend the WALE from 1.8 years to 4.7 years. Once again, the 3 master leases that were renewed were for properties, Chongxian Port Investment, Fuheng Warehouse, and Beikang. Beikang initially was the struggling asset with lower occupancy, but so with the extension of the master lease, this has been delayed. EC will also announce the proposed acquisition of yield accretive acquisition of the Rofer asset. This asset is actually located right beside a Fuheng warehouse, and it will be leased out on a 5+5 year master lease to 2 main master lessees. So it has a 6.4% acquisition yield, and it will lift MPI and DPU by 16.4% and 1.6% respectively. So this asset will have built-in rental escalations of 2.25% per annum. So at the current master lease rates, this is actually above market rents. But with the escalation and the 5-year term, at the end of the 5-year term, the rents will be expected to be at market. So meaning to say that the rental escalations will be slower than the projected market growth, but all in all, at the end of 5 years, it will be in line with market. So we expect the full year 2019 and 2020 DPUs to increase by 0.6% and 6.17% respectively. On the negative side, 100%, which is all of their debt, will be maturing in July 2019. The management is currently in the final stages of securing their refinancing, and it's likely to be on a 3-year term. So the bad thing is that the debt maturity or the debt profile will once again be very lumpy. So for the outlook, as mentioned, with the extension of the master lease, the committed portfolio occupancy is almost 100%. This provides much income stability, especially in the face of global and geopolitical tensions and economic uncertainty. One thing to note is that the proposed acquisition of this Rofer asset will push gearing from 31% to 41%, effectively using up all of the debt headroom. And so one thing to note is that before this acquisition, 68% of the MPI is actually covered. It's actually from master leases by the sponsor. So we maintain our buy recommendation with a higher target price of 0.87 cents, and this is to account for the yield accretive acquisition. With that, the ECY actually trades at 8% dividends yield and a price to NAV of 0.93 times. Okay, moving on to Tara for CDL.
So CDL released their 1Q19 results 2 weeks ago. Top line did not meet our expectations, mainly due to the lumpy recognition of the EC last quarter. So recall that EC, the recognition is upon completion. So excluding this EC contribution in 1Q18, revenue would have risen by 6%. And for the PATMI, there was an increase from the contribution from the South Beach residences. And before that, the operating level, there was a realization of 144 million pre-tax gain from the divestment of Manulife Centre in January. This was under their PPS structure, PPS2. For positives, their recurring income shown through. So this was mainly due to the 3 rental properties that they acquired in the second half of last year, the 2 London buildings, as well as the remaining 60% stake in Central Mall Office Tower. And this segment was also the front runner among all business segments this quarter on both the PBT and EBITDA level. The rest of the segments did not record again. And Singapore residential game, they're still very strong at that. Though the number of units sold in 1Q19 was lower year on year, but the sales value was down less than proportionately due to the higher ASPs of the projects sold. This was driven largely by Boulevard 88, which is a high-end residential project. And this contributed to close to half of the total sales value for this quarter alone. And this quarter captured the highest unit price sold to date for this development. This is about $4,900 per square feet. The negative is that the hotel operation segment is in the red. So while revenue was stable year on year, profit before tax from this segment recorded a slight dip, and this was mainly due to the US hotels. If we recall, last quarter, the management guided that the labor union laws are still quite tight in the US, so there's not much flexibility in terms of the operating cost structure. And also there were higher net financing costs for this segment. Other things that happened during the quarter was their proposed acquisition of 24% stake in Singtel Property Group. This is one of the top China developers in China for 1.1 billion Singapore dollars, and they also acquired a 70% stake in one of Singtel's prime commercial assets. So this gives them access to a pipeline of 70 development projects with a total gross development value of 130 billion RMB. And they also have 31 investment properties in malls, offices, hotels, and service apartments. With this, CDL's asset allocation in China will be increased from 9% to 15%. So this overtakes UK as its second biggest contributing geography. And there's a 6.7% pro forma accretion to EPS, while pro forma NAV remains constant. So this is all still illustrative. It's contingent on the estimation of the PPA, the purchase price allocation to Singtel's asset. And other than that, they also acquired a stake in iREIT Global and its manager. They acquired a 50% stake of the manager, which essentially makes them a co-sponsor on the ownership level, and a 12.5% stake in iREIT, a 12.4% stake in iREIT Global. They also expanded into the UK private rented sector, so they acquired a site to develop a build-to-rent resi project. So these two items will help to boost their recurring income segment, which we talked about earlier. So this will be the segment that will be the focus going forward. And the on the Singapore residential, they had a 40% JV stake. They won a site in Sims Drive. This is a 99-year lease site, and estimated 560 units to be built on this. So going forward, the outlook is that their proposed stake in Singtel Property Group will really help to accelerate its entry into China's residential segment. If you follow this counter, you know that it really took them quite a while to penetrate China in a meaningful way. So this would immediately help them to get a foothold within China, especially if they don't have the expertise in development. It's very hard to go in organically by their own. And the recent actions like the stake in iREIT Global and the private rented sector will eventually help to boost their recurring income. And while they are still largely in Singapore residential, we note that the earnings drivers will still substantially weigh on the sales efficacy of their 5 launches this year. One of them is the only EC launch of the year. It's called Piermont Grand, which is the formerly known as Sumang Walk. We upgrade to buy with an unchanged target price of $11.82. If you take a look at the price to NAV table, it's currently trading at a discount at 0.8 times. And moving on to Dasin. So the revenue, so this is under our stock flex program. Revenue was below our expectations due to this new AI initiative at one of their malls, Xiaolan Metro Mall. And previously there was already an AI and for this mall, and this is just a new AI. So this was this contributed to the lower than expected revenue. And the positives from this set of results is that NPI margins improved across the board for their four portfolio malls. Lower property expenses were recorded across all assets. These are the maintenance, cleaning, advertising, and promotion costs. For the negatives is that the occupancy, portfolio occupancy took a slight dip, and mainly due to the same mall that we talked about, the Xiaolan Metro Mall, and this is a 1 million mini AI, about 1 million Singapore dollars. And what happened is that they are taking up some space of the top floor to reconfigure to replace new tenants. So this is expected to complete in 3Q19. Outlook is that favorable renewal and escalation rates are progressively expected at Xiaolan Mall. This is their second biggest mall. And there's still this inorganic growth prospect. The ROFR pipeline of 20 properties, so more and more have been being completed. The Domen and Shunde Metro Malls, these could be possible acquisition targets as they were just recently completed in 2018. So overall, we maintain accumulate with an unchanged target price of 94 cents. So for Banyan Tree Holdings, the revenue also, the revenue was quite a big dip. This was mainly due to a lot of one-offs. As you recall, there were quite a few happenings in terms of the divestment of the BTAC stake. So this is the holding company that holds their assets in China, as well as the entire divestment of the Seychelles portfolio, which they continue to operate on a management contract basis. The positives is that there had been effective cost control. Total costs and expenses were down more than proportionally compared to the decline in revenue. This was attributable to all expense categories. Mainly to note that the admin expenses were lower because of the lower legal and professional fees relating to the divestment in BTAC stake. And there are also lower provision for bonus incentives and lower travel agent commissions. Forward bookings for 2Q19 actually edged back up after a decline in 1Q19. So this would play positively for the hotel investments the following quarter. The negative is that their hotel investment segment is still suffering from the Thailand underperformance. Excluding the Seychelles portfolio, however, revenue from this segment would still have declined about 6% year on year in 1Q19. So so Thailand is actually their biggest market, and Thailand RevPAR decreased 17% year on year in 1Q19. This is mainly due to some ongoing renovations at their flagship resort, Banyan Tree Phuket, and this makes up about 60% of the entire hotel investments segment. So this is expected to complete in end of this year, and had been the main reason for the weaker bookings. RevPAR in Maldives, however, recovered 14% this year. This was mainly due to the 45-day declaration of state of emergency in the previous quarter. So going forward, the main thing for them is that the trajectory in terms of the hotels from their two partners, Accor and Wangke. And currently there are 53 hotels under the Banyan Tree umbrella of brands that are slated to open through 2019 to 2022. And overall, we maintain accumulate with an unchanged target price of 76 cents. Moving on to FCT. So this is just a quick update on their Waterway Point acquisition. They proposed to acquire 33.33%. So this is about 1/3 stake of Waterway Point from their sponsor Frasers Property Limited. Total consideration is about 433 million, but on a 100% basis, that's about $1.3 billion for the whole asset. And they had also done an EFR of 184 million new units. This comprises of a private placement as well as a pro rata non-renounceable preferential offering at 2.382 and 2.35 per new unit respectively. Last close was about 2.4. And the impact on SCT is that I've laid out in the table on the left. The expected pro forma DPU accretion is about 0.29%. And if you include the stake in PGIM Asia Retail Malls Fund, that would be about plus 0.65% in total. And gearing rises just marginally if you include both acquisitions. And if you look at the pie chart above, this would be quite a sizable shift in their portfolio. If you include Waterway Point, that would now comprise about 16.5% of their total return. So currently, their two biggest malls, Causeway Point and North Point North Wing, already would comprise close to 80%. So this helps to diversify their earnings base. So what do we think? We believe that there's upside for rental escalation and reversion rates. This mall is still pretty new. They only opened commenced operations in 2016. So they've just gone through their first cycle of renewals. They're not able to disclose yet the reversions that were recorded, but no doubt that this is supported by the recent resilience in fringe rental rents, which have been catching up very nicely to central rents, and as well as the Waterway Point specific attributes such as the proximity to the transport nodes and the catchment area, given that most of the estates have only recently TOP'd. And according to C3, which they are independent market research company, the population in the trade area surrounding is expected to increase by CAGR of 3.8% by 2023, and this comes even after the stabilization phase of the area. So if you take a look on the right, these are the operating metrics of the mall. Tenant sales would have increased 10% just last year alone. And outlook, their MPI yield of 4.7% is in line with their FCT's portfolio average and is poised to match that of its bigger malls, Causeway Point and North Point North Wing, which are currently north of 5%. And as mentioned earlier, this acquisition would help to diversify their earnings base. So overall, we maintain accumulate with and factoring in this acquisition, our target price would rise from 2.31 to 2.36. And we adjust our FY19 and FY20 DPU estimates by 0.4% and 2.2% respectively, assuming that this deal is completed by fourth quarter of their financial year, which ends in September. Lastly, the REITs monthly. So the S-REITs are still going pretty strong after the bullish uprun this year, 9.5% year to date. And however, the yield spread actually went further below the -1 SD line. Right now, it's about 241 basis points. So this is further away from the historical average of 258 basis points. However, as we have always mentioned, this can be mitigated by the rental growth in the different subsectors. So it's more important to pay attention to those the subsector specific factors. 3 months saw had actually back up to 1.97%. Recall that actually it went up very close to 2% before dipping down to 1.93%, and then now it's back up to 1.97%. So just go through the different subsectors since the quarterly data came out. On the top left graph, this is the retail index and occupancy. Both retail index and occupancy declined year on year to 98 points and 91.3%, and this is actually in tandem with what most of the retail REITs have reported in terms of negative reversions, and some of the some of their malls occupancy weathering off. And the graph below shows the fringe and central median rentals per month on a quarterly basis. So this kind of relates to what I talked about in FCT slide earlier. So the fringe retail median rents are playing catch up to the central retail median rents, and so that means that the gap between the two are closing up very nicely. And office rents still remain very buoyant. In fact, occupancy even edged up slightly to 88.2%. And the central median rents are still healthy, while fringe office rents are constant year on year for the quarterly basis. Property price index hit a 21-year high, so that's a very big jump with a rise of 10 points year on year in 1Q19. Industrial rents and occupancy both remained flat. Business parks was the only segment that recorded positive growth in rents. And similarly, the industrial prices have been flat across the board for 1Q19. Finally, for hospitality, average RevPAR declined 6% year on year to $182 in March, both on lower occupancy as well as average room rates. Visitor arrivals, on the other hand, recorded a strong 13% growth year on year in March. In terms of the hospitality REITs, a lot of them for this fiscal quarter, they recorded negative RevPAR growth as well. This is mainly due to the absence of the biennial Singapore Air Show event, as well as the various meetings leading up to the ASEAN chairmanship. And another key thing that happened in the hospitality sector would be the URA's maintaining status quo on the ruling on the short-term accommodations. So that provides a slight relief to the hospitality REITs. Overall, we maintain our stance neutral on S-REIT sector, while we have selective subsector preferences on the office and hospitality subsectors. And on the right are latest calls and target prices on the REITs under our coverage. I'll pass it on to Edmund.
Thank you, Tara. So in terms of the sector performance, defensive stocks are the defensive stocks are doing better than the rest of the other sectors for the past 1 month, and especially for the past 1 week. This is mainly because investors are switching to a more defensive play with the uncertainty going on with the trade war. So the defensive sector, such as utilities, mainly does business in the US, and it is minimally exposed to the import-export uncertainties from the trade war. We think that the defensive stocks will continue to outperform the market, especially because we do not see that there will be a trade war settlement until maybe during the G20 summit, which will happen on the 28th of June. In terms of the real estate market, sales price for houses have gone up by 8%, whereas new home sales are up 7% year on year. The purchases of houses that have yet to be built has also increased, which means that there is still strong demand. Overall, we see a continued bullish trend for the residential real estate market, with mortgage rates declining and steady job and wage gains. So it is likely to be a positive sign for home builders. As for the manufacturing sector, it still looks weak as the new orders for the core capital goods have declined for 2 out of the previous 3 months, as businesses continue to work on their stockpile inventories, which is the main reason for the higher than expected growth in the GDP for the first quarter. There will be less new orders from factories. We think this weakness in capital goods, new orders, and industrial production will likely persist unless there's a settlement of the trade war, which will then provide a boost to the market. So manufacturing and chip makers especially will likely underperform the market. So during the latest Fed meeting, the Fed still signals that they're going to be patient. They will neither raise nor lower interest rates for some time to come. So this is the list of the upcoming earnings release. Okay, now I'll pass on my time to Jie-Yuan.
Thanks, Edmund. For China last week, trade will still be the main factors to affect the stock market. For Chinese government reactions to seeing PBOC's released schedules, how they are going to cut the trade war rate by 3 steps. Also, against the Americans, the financial seconds, for 10 companies and Huawei, China government released the tax reductions for chip and the software companies. Whereas the last round of the tax-free was ended at 2017. So we are thinking this direction is mainly focused on offset the negative impact of the trade war, but want to be boost for this kind of company's business. The tax after this 2 years will still be 12.5%. Crossing for stock market performance across the tech sectors, we are seeing the defensive stocks like the utilities and the financial stocks that perform well. These are only two sectors are gaining the positive performance for last week. We are positive on the financial sectors, the performance. We are seeing the banking sectors are performing quite well. This is the list of the 15 and diverse banks in CSI 300 and their weekly performance. We are continuing to be positive on the banking sectors. We are seeing the relative performance are getting well. Also, the loan to deposit ratios, like main business of the banks, are keep increasing. Also, the FTSE announced last week they are included over 1,000 China A shares in the FTSE flagships index, of which the 15 stocks are finance stocks and accounted for over 40% of the total market caps. Also, for the MSCI, for the China A shares included the MSCI Emerging Market Index, there will be 242 stocks. 22 stocks are, of which 22 stocks are bank stock and accounted for 30% of the total market shares. This is a list of 22 bank stocks that will be included to the MSCI Emerging Market Index. For the reference, this is the few ETFs that track the China financial sectors or have a big market weight on the Chinese bank. That's all for today's sharing. If you have any questions, please leave on the chat box. Thank you.
Hi, there's a question on the impact to Netlink for 5G implementation in Singapore. So we think 5G is positive for Netlink because IMDA has indicated 5G to be a standalone network, which means more fiber connections needed. And this is to support the telco rollout of 5G network across many more base stations needed. So we do not foresee 5G replacing fixed broadband, as typically a household have several connections to Wi-Fi. Unless there's a very specific use case, this impact on 5G is positive for Netlink.
So if there's no more questions, I think we'll end the webinar. Thank you everyone for tuning in, and thank you for your questions.